Recently, there was an IPO. Each unit of this IPO was priced at 10.6 lakh. Now, despite this high price, there was a high demand for this issue. The individual investor segment was oversubscribed by 6.4 times. This was the IPO of PropShare Titania, a small and medium REIT. So why were investors chasing this issue? This was the second issue of SM-REITs, a new asset class that can deliver equity-like returns. Hello and welcome to ET Money's YouTube channel. In this video, we'll break down SM-REITs from the grounds up. We will discuss their structure, regulations, business model, expected returns and risk. So this will help you decide if they are suitable for you. But before we get into that, let's understand why there is so much demand for this new asset class. In India, if you buy a commercial property, you can make around 6 to 7% in return every year. Say, you buy a piece of commercial real estate that costs 2 crore. On average, investors would earn 14 lakh in rent every year. Let's say the property grows by another 6 to 7% in value. Your returns will be around 12 to 14%. But that's just on paper. You will also have expenses. You will need to pay brokerage, maintenance, repairs, etc. In the best case scenario, an investor would end up with 10 to 11% returns. Now, SM-REITs can give you this kind of returns without the hassle of arranging tenants and property maintenance. That's why investors were excited about this IPO. Now, let's understand what SM-REIT is and how it's different from traditional REITs. But before that, a quick update. You can now get cash to enjoy your present while staying invested for your future with loans against mutual funds on the ET Money app. The interest rate is just 10.75% and there is no fixed EMI. Pay interest monthly and repay the principal amount at your convenience. Plus, there is no need for a CIBIL score. So go ahead, check your eligible limit on the ET Money app. Over the past few years, REITs have become a familiar option for investors looking to access India's commercial real estate market. They offer predictable rental income, capital appreciation, and liquidity through stock exchanges. Now, for many investors, they become the real estate equivalent of large cap stocks, stable, regulated, and relatively low risk. Yields typically hover around 7% pre-tax and around 6%. For instance, let's consider Embassy Office Parks, the most liquid REIT in India. At the current price of 392, its gross yield comes at 6% based on annual distribution of 23.2 rupees. Now from this 23 rupees, 18 is dividend component which is tax-free, while 5 rupees is other income which is taxable at slab rates. So Embassy Office Park's net yield would come to somewhere around 5.5% without factoring in the capital appreciation. Now while traditional REITs offer accessibility and trust, they also have limitations. The underlying assets are often mature and concentrated in prime urban pockets, limiting upside. And the structure by design is built for scale and not flexibility. On the other hand, SM-REITs operate at a different layer of the market. They focus on smaller ticket size, income generating assets. Think pre-leased warehouses, medical centers, boutique offices, or retail outlets in tier 2 cities or emerging business corridors. For example, PropShare Titania on 6 floors in a commercial office building in Thane with 100% occupancy rate. The offices are leased to Fortune 500 companies, MNCs, and tenants like Aditya Birla Capital. Now, these are assets that typically fall outside the radar of large REITs but can offer significantly higher rental yields, often in the 9% range. The listing documents of PropShare Titania state an annual distribution yield of 9% across FY26 to FY29. Now, even though these are not guaranteed, the RHP of PropShare mentions a guaranteed 5% rent escalation annually, which provides some assurance. We will come to yields and returns later in this video. Now, besides yields, there will be capital appreciation. So, if you add it all up, investors can get around equity-like returns and much higher than traditional REITs. Now, what sets SM-REITs apart is the balance they strike. Sponsors get more flexibility to pick lower cost, higher yielding assets compared to the traditional REITs. Investors, on the other hand, get a direct exposure to high performing, under-penetrated real estate pockets without taking on the ownership risk. Now, SEBI also mandates SM-REITs to disclose their net asset value, at least semi-annually. This helps investors to gauge the real value of assets backing their units and assess if they are paying a premium or discount to actual asset value. Alright, so far we've had 2 listings. There are more in the pipeline. More issues are likely to hit the market soon. Let's take a look at them. Since SEBI introduced the SM-REIT framework in March 2024, a handful of platforms have received regulatory approval to raise money. However, very few have gone live. At the time of shooting this video, only 2 SM-REITs were listed on the BSE, both by Property Share Investment Trust. PropShare Platina was the first SM-REIT to list on BSE back in December 2024, raising a little over 350 crores. This was followed by PropShare Titania, the second and most recent SM-REIT to complete the full cycle from SEBI approval to public listing. The 473 crore issue opened in July 2024 and was listed on the BSE on August 4 at 10.6 lakh rupees per unit. HP's Investment Trust received SEBI approval in April 2025 and is expected to launch its SM-REIT IPO in 2025. Impact R SM-REIT, sponsored by Rudra Abhishek Enterprises, was approved in late 2024 but hasn't yet announced a public launch timeline. Amberston, AMSA, and Yield Foundry have also been registered with SEBI, though as of now, no public documents or IPO schedule has been filed. Together, these developments show that while SM-REITs are still a young category, interest is steadily growing. Investors currently have limited but expanding choices, with more schemes expected to enter the market over the next 12 to 18 months. Now, with this context in mind, let's understand how SM-REITs are actually structured and how they generate returns for investors. At a structural level, SM-REITs are designed to pool investor capital into a trust that holds income-generating properties. The rental yield these SM-REITs collect is passed on to the investors. Now, the overall returns depend on tenant stability, rent escalation, the eventual sale of property, and on the trading price of units. Because ultimately, returns depend on your purchase price, and if you buy when they are trading at lower prices, you can make higher returns. So basically, the whole life cycle begins with the sponsor or platform identifying and acquiring completed pre-leased assets such as logistic warehouses, a medical facility, or a retail outlet with a long-term lease. Now, these assets are typically acquired through a special purpose vehicle or SPV and then held under the SM-REIT structure. Now, investors subscribe to units of the REIT by investing a minimum of 10 lakh as per SEBI guidelines. These units entitle them to a proportional share of the net rental income, which is distributed quarterly or semi-annually after accounting for expenses and management fees. Now, over the life of the investment, typically 5 to 7 years, the property is managed professionally. The management takes care of the lease renewals, maintenance, and compliance. While no rule mandates an eventual sale, if the sponsor does decide to sell, the REIT may choose to reinvest proceeds into new asset or distribute them to unit holders, based on strategy and market conditions. Alright, so I hope you now have a clear understanding of how SM-REITs work. But before we move on, there is few important details you should know, typically around fees, debt and liquidity of SM-REITs. First, the fees. There is a property management fee and an annual scheme management fee, which add up to the total expense ratio or TER. Now, in the case of PropShare Titania, the RHP mentions a total expense ratio of 0.34% for FY26, rising to 0.86% by FY29. Separately, there is a one-time transaction fee of up to 1% on acquisition and up to 3% on divestment. But remember, these are one-off expenses. Second, the use of debt. Some SM-REITs borrow a portion of the money needed to buy the property. This can boost returns when things go well, but can also increase the risk. And remember, any debt has to be repaid before investors receive their share of profits at exit. And finally, liquidity. SM-REITs still lack volume. For example, PropShare Platina began trading on BSE in December 2024, followed by PropShare Titania's listing in August 2025. But both these units hardly have 1-2 units traded on a daily basis. Okay, now let's move on to SM-REITs returns expectations and their yields. SM-REITs generate returns from multiple channels: steady rental income from leased properties, interest on intercorporate deposits, and other income such as bank deposit interest. Over the holding period, investors may also benefit from capital appreciation when the underlying property is sold. Now, while returns vary by property, tenant, and platform, early data gives us a realistic benchmark. According to the offer documents of PropShare Titania, it earns around 34 million rupees monthly as rent income, Apart from this, it earned 5.6 million from other income in 2025. Now, according to Val Trust, a property valuations expert, SM REITs are projected to deliver IRRs between 12% and 14% over a 5 to 7 year horizon. These are based on assumptions of 5 to 7% annual rent growth, stable occupancy, and a resale at prevailing market cap rates. However, that said, investors must be mindful of platform level fees, typically 0.5% to 1% annually. This can reduce overall returns and should be factored in while evaluating net IRRs. Still, the fees of SM REITs are lower compared to traditional REITs. Now, as far as taxes are concerned, the taxation of SM REITs has been aligned closely with traditional listed REITs. As we saw earlier, SM REITs distribute income to investors through a variety of ways, and the tax treatment for each of the distribution avenues is different. The interest component is taxable in the hands of the investor. The dividend component is tax-free if the SPV has already paid corporate tax under the old regime, but it's taxable if the SPV opts for the concessional 22% corporate tax regime. The capital return component is not taxed when received, but is taxable later as capital gains when the investor sells the unit. The rental income component is taxable in the hands of the investor at slab rate. Also, capital gains, while possible, are not guaranteed. Returns depend on market conditions, buyer appetite, and lease continuity. That makes the rental yield a more reliable core return metric. So in summary, SM REITs can offer higher income potential than listed REITs or bonds, but they come with longer holding periods, moderate illiquidity, and require careful due diligence. Now, while returns may look attractive on paper, they are only as useful as your ability to actually access them. Which brings us to a critical question: how liquid are SM REITs and how easy is to exit when you need to? Liquidity remains the most important constraint and arguably the Achilles heels of SM REITs today. Unlike listed REITs, which are traded daily on stock exchanges and have decent volumes, SM REITs, because of their expensive tag, aren't attracting much interest. What that means in practice is that most SM REITs, at least for now, should be treated as illiquid long-term investments. While rental income may be paid regularly, their principal amount cannot be withdrawn on demand. Even schemes that achieve listing status may not offer the day-to-day tradability investors associate with traditional equity or debt instruments. For investors, this makes SM REITs best suited for long-term allocations where capital is not required for near-term goals or liquidity needs. So clearly, liquidity remains a concern. Now, another issue is tenant concentration. If one tenant moves out or defaults, it can derail cash flows. And let's not forget the underlying valuation risk. For the resale price depend on market cycle, and there is no daily benchmark like listed REITs to show you what your units are worth today. In short, SM REITs offer higher yields for a reason, and that premium is compensation for liquidity constraints, concentrated asset exposure, and longer holding periods. So I hope by now you would have gotten the clarity about SM REITs. But who exactly should be investing in SM REITs? Is that for you? And where is this asset class headed? SM REITs come with a minimum investment of 10 lakh rupees per scheme. These can be used as diversification for your portfolio, so it's best to allocate up to 5 to 10% of your money in them. That means to really fit an SM REIT in your portfolio, you should ideally be managing at least 1 to 2 crore overall assets. In simple words, this is suited for those with larger portfolios who want a steady yield generating slice along with equities and mutual funds. As an investor, you have to remember a few things before investing. For starters, if the SM REITs price rises after the IPO and you pick it up, you'll probably get a lower yield. Then there are interest rates. In the past, we've seen that whenever the RBI raises interest rates, the share price of REITs drop and vice versa. The sponsor track record also matters. If the people behind the SM REIT are seasoned property players, that's a plus. And let's not forget that real estate runs in cycles. We may not have seen a big bubble like 2008 bust recently, but the risk never fully disappears. And finally, the kind of property on offer matters a big deal. While office space in established business district like the prop share Titania's Thane land seem like a predictable bet, warehouses and newer formats can get tricky. If a shiny new logistic park opens up a few kilometers away, rents in your property can suddenly lose their edge. And with this, we have come to this end of this video. I hope this video gave you something to think about when you're looking at SM REITs as your next real estate investment. I hope you found this video useful. And if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.